simply invest on mutual fund or somewhere, then we can grow our money. But they really, the analysts, they will tell you, enlighten us that how best we can make our financial management and run the business. So we'll, with this introductory remarks, we'll go straight into the technical session. So our first speaker will be Mr. Manish Galwani, and I'll be requesting sir, please kindly deliver your talk.
Yeah. Thanks everyone for having me. I really thank Vibha, Kamalputra and whole of NDRI for organizing this event and calling us here. So, what I'm going to talk about is hopefully something that interests all of you. I know the heading asset allocation may sound very technical and boring, but simply put, I'm going to talk about how we should think of saving money. See, what we have seen is that a lot of times people spend a lot of effort and time to earn money, but the same amount of effort and time is not given to how to save money. And when we say asset allocation, it's all about where should we put our money so that our objectives are met. So before going into the asset classes, couple of important points. See, one of the most important things about saving is how do we counter inflation? What is inflation? Inflation is basically if you have 100 rupees today and inflation is 5%, it means that in real terms, in purchasing power, it becomes 95 at the end of the first year. So if you don't save and make some returns, our purchasing power of our saving will actually go down. So a lot of times when we look at savings, we look at what is real return. Real return is nothing but what we are making on the saving we are doing minus inflation, because unless we beat inflation, we are actually not enhancing our purchasing power. So one big objective of our saving is to actually make money more than inflation. So now, if you see what has happened in India, and I'm going to talk about what different saving avenues have done over long period of time. If you see India, basically most of the savings are in real estate and to a certain extent in gold and bank FD. Now, if you see the amount that is saved, very roughly in real estate, India has saved about $4 to $5 trillion. In gold, it is about $2 trillion. In bank FD, about $1.5 trillion. And in equities, $1 trillion. So the highest investment has been in real estate. The lowest investment has been in equities. But if you see, the biggest return actually has been made in equities. So in one sense, you can say that India the saving method has not been very optimal because people have missed out on the asset where the biggest return has been made. So in last, let's say 30 years, uh, equities has generated about 16% return. Real estate has done about 7% and gold has done about 19%. But as I said, most of the investment is actually in real estate and gold, where the returns have actually been lower. Which is why I'm saying that we should think a lot about where we are saving. Because if we save in the right asset class, we will actually benefit a lot by increasing our long-term wealth. Now, equities in India has done well, and a lot of time people think that India's growth has been strong, which is why equities has done well, which is true to a certain extent. But the surprising part is equities has been the best asset class not only in India but across the world. So if you see most of the developed countries, even there the long-term return on equities has been very substantial. So again, I've shown the real return and the actual return. So if you see the real return plus inflation is the actual return. So whether it is Australia, Canada, Japan, South Africa, UK, US, all these are very developed countries where the GDP growth is much less than India. So India typically grows at 7-8%. In these countries, the GDP growth rate is only 1-2-3%. But even then, equities has given very substantial returns, which is again proving that when we save our money, we should definitely look at equities. This is a bit complicated chart, but the simple point here is that if you see US and Japan, ultimately if over long periods of time, the real return on equity, that is inflation, above inflation, how much equity is generated, tends to converge to 5-7%. Usually you will see that the money you save in the bank will generate about 0 to 2% above inflation. So like bank FD today on 1 year basis will give you 7%, whereas inflation is about 5%. But if you see equities long term, even in very developed markets like US and Japan, long term it does give you 5-6% minimum in real terms. The other thing is that when you say equities, this is the stock market, and there are companies of various sizes. So we typically divide the stock market into 3 parts, what we call large cap, mid cap, small cap, based on the size of the company. And again, if you see long-term data across different countries, the smaller companies tend to outperform. They may be a bit more risky, their fortunes will go up and down, but again, if you have long-term money where you can keep the money invested for 5, 10, 15 years, typically a mid and small cap fund will do better than the fund which invests in larger companies. And finally, one important thing we should understand when we do our saving is ultimately we are saving in India, we are saving in Indian currency. And one important concept to realize, because a lot of saving is affected by our currency. So let's say US dollar rupee conversion rate in 1991 was 20 rupees. Today it is about 84 rupees. Now what drives this trajectory of Indian currency versus US dollar? That again comes back to the central concept of inflation. Whichever country has higher inflation, that country's currency will depreciate against the country where inflation is lower. So in a way, inflation eats away the purchasing power of the country. And therefore, if inflation is high, the country's currency weakens. So if you see long term, it is quite surprisingly scientific that the difference in inflation. So last 30 years, US inflation has been 3 to 4% less than us, and you will see that the rupee has depreciated 3 to 4% on 30-year basis. Similarly, if you see US versus UK, the same thing has happened. So when we invest, sometimes we need to see and think about how our currency will do, because some of these investments like gold, they are actually dollar assets. So based on what you think of the currency, we should invest in that manner. So just to summarize the different assets, how they rank. Now if you see equities, as we've seen, the return is high. The risk, it probably ranks a bit low because it can go up and down a lot. But one important thing is you should also look at other metrics like taxation and liquidity. Liquidity is basically how soon can you convert it into cash. See, all of us face emergencies, and a lot of times the purpose of saving is to let us use that saving for a lifetime. So if you have real estate, for example, if you have a big house, it is very cumbersome to sell that house. So we say that the liquidity of the house is very low because it takes time to find a buyer, it takes time to do the registration, etc. But if you see equities, you can liquidate it very fast because if you sell your shares today, you will get the money in the bank in 2-3 days. And let's say out of 100 rupees, you need only 20 rupees. Unlike a house where you have to sell the entire house, you can sell only 10-20% part of the asset you have. So that way liquidity is high, and taxation also is very beneficial because beyond 1 year, if you hold the stock or mutual fund for more than 1 year, it qualifies for capital gains tax at 12.5% now. Whereas if you put money in a bank and you're earning interest, you will pay 30% as tax on the interest that you earn. So that way, equities has better taxation also. So if you see all the 4 assets that typically all of us save in, we will see that apart from risk, where the equities go up and down, but versus real estate, gold, bank FD, in all other 3 parameters, equities ranks better. And how to handle this risk is very simple, that you should have equities for long period of time. So the money you keep in equities, you should invest with the view that it will be there for 3-5 years and not the money you think you need for the next 3-6 months. So that is very important to understand, that because equity markets are unpredictable in the short term. See, long term they tend to generate a lot of wealth, but because near term they can go up and down, you should not keep the money that you need for the next 3-6 months in equities. That part, probably gold and bank FD are good, even, and real estate also, you should keep only the long term money. So it is important to understand that equities is a place where you should keep the money that you have for the long term, and that's why you get very good return in the long run. So I'll just skip this and just go to the at just interest of time, I'm just going to the central part of the presentation. So how should we allocate our savings? First of all, just a list of, as I said, the major places where we can save, because even among these big 4 or 5 asset classes, you have different kinds of sub-asset classes. So as I said, in equities, you can be in large companies, small companies, mid companies. You can also have some exposure to global equities. So global equities typically are US equities, Europe equities, China equities, and US in particular is a very important part of the global equities. 60-65% of global equities actually from US. You might have heard of all these big companies like Apple, Google, Nvidia. So they are listed in US. So if someone feels that at some point you may have some dollar liability, that is, you may have some spending in dollars, you can also look at international equities. And then you have commodities, which is oil, steel, aluminium, etc. Then you have fixed income, which is mostly bank FD for people. But you can also have debt mutual funds. You can also have government bonds. So there are different kinds of debt instruments. And finally, real estate, commercial, residential, there are different types. So one very important thing which has been proven by data is, and I think it's good for people because it keeps things simple. When you see the amount of money people have made, it has not really mattered so much that what you own in the asset class. What has mattered is what asset class you have owned. So what I mean to say is, let's say a person A has 40% in equities and 60% in gold, and someone else has zero equities and 100% gold. Then within equities, within that 40% which the first person had, whether you own large cap, mid cap, what fund does not play that big a role versus this 40 versus 0. So if you first, based on your needs, you decide a good asset allocation, then you don't really need to change it for a long period of time. And if that asset allocation is founded on sound principles, the smaller decisions, which fund you invested, when you took out money, when you put back that money, that really has not mattered. So as this chart shows, almost 92% of difference in wealth people have made is actually from deciding the asset class rather than owning what within that asset class. Also, I think one should be careful that while, for example, equities is good in the long term, it doesn't mean it does well all the time. So if you see this chart where we've shown in different calendar years among the major asset classes what has performed, you will see that sometimes gold does well, sometimes equities does well, sometimes international equities does well, and sometimes debt does well. So while long term the data is more clearer and easier to decide on, in 1, 2, 3 years we will definitely see things bouncing around, that one asset will do well and then some other asset will do well. And this is important because people fall into this trap of chasing assets. So typically the way people invest, a lot of people invest is they will see what has done well, and it comes on newspapers, you will see newspaper headlines, you will see your neighbors discussing it, and then after that asset has done well, you will go and invest in that asset class. So if you see, for example, one data analysis we had done, that let's say you first decide a fixed allocation to those 3 or 4 asset classes, saying I will invest, let's say, 50% in equities, 20% in gold, 20% in debt, 10% in commodities, and you keep it at that level. And the second way to invest is you chase performance, what has done well, you invest in that. You will see that the first method, where you just decide what is good for your needs, actually outperforms the second method, where You see what has done well and you go and invest in that. So this performance chasing behavior is actually very dangerous, and it can lead to big losses if you keep investing in asset classes which have done well in the last 1 or 2 years. And also when you see the correlation of different asset classes, gold typically has a very good diversification potential versus equity because gold returns are negatively correlated to equities. So generally if you mix equities and gold as your primary investments, that has proven to be a good combination. So if you see one of the funds we have where we have both domestic equities, international equities and also gold, you will see that let's say on 5-year return, the return is very good but the volatility is very low versus putting all the money in equities. So as I said, when you mix 2 or 3 different asset classes and you do the research and have a good proportion, this diversification can give you maybe slightly lower return, but in bad years, your portfolio will fall less than just investing everything into one asset class. So you will kind of get comfort and sleep well at night if you have a good combination of asset classes. So a lot of times when we do our personal finance, we should first think about what are our objectives. Let's say if someone is at 30 years, he wants to retire at 55 years. So how much money you need at the end of that 55 years. You see the time frame, and you should also have a feeling of your risk appetite, because let's say someone is salaried, then that person can take slightly more risk in assets than someone in business, because the business still might be very volatile. So some of the common rules of thumb for deciding how to invest, one is 100 minus X rule. So what this rule simply says is that if your age is X, then you can put in equities what is 100 minus X. The logic here is the younger you have, the more time you have for your earnings to compound, and you don't need that money because you're earning, you're not retired obviously. So you should use that time when you're working to invest in something which will give you high return and where you don't need the money fast, which is equities. So if someone is 30 years, he can have 70%, which is 100 minus 13 equities. If someone is retired, then they should not take so much risk. So if someone is 65 years, then they should have 100 minus 65, which is 35 in equities, and rest in slightly safer assets like debt, gold, etc. Another rule of thumb is that first you set aside 12 months of expenses, have 20% of the rest in gold and 80% in equities. So this goes back to the point I'm making, that gold and equities tend to have very different returns in a year or 2 year kind of time frame. So it's good to mix gold and equities, and you just keep a certain amount for your living expense or 1 year of living expense in, let's say, your bank account. And the third simple rule is that, look, all of us finally want to have a good corpus for retirement. And one rule of thumb as to how much money you need is that you should have roughly 30 years of living expenses at retirement. So let's say you have, you're retiring at 55, then you should estimate your annual living expenses. And given the longevity of people on an average today, you should have 30 years of expenses. So these are very basic rules about how we should manage our finances, which are very, very important. So given this framework, I just put down what I think is one good way to think about how to manage savings. So first of all, India is obviously from a relatively low base. As I said, is a good diversification to equities. Uh, Indians generally have invested a lot in real estate, which I think is not a great idea. Because if you see the returns, if you see the taxation, if you see the liquidity, to my mind, real estate is not a good way to save too much money. Obviously, a certain amount we will need to have for the house we're living in, maybe, but beyond that, in general, I feel people have over-invested in real estate given its attributes. And one last important point is that if you make a plan like this, you should be slightly dynamic around this. So let's say if you have fixed 45% in equities, whenever market does well, you can go down to 35. Whenever markets fall, you can go up to 55. But you should not deviate from this plan a lot, because see, while most asset classes have reversion to mean, but there are very long periods of time where they may not perform. So small amount of dynamic planning you can do around the core plan, how you want to save money, but generally it's not prudent to be violating this rule by a big amount, because this rule is based on your long-term goals and risk profile, etc. So what is for the long term, you should not tinker with it too much. So again, a lot of it will depend on your personal time frame, risk profile, objective, etc. But I think a good allocation for someone who's age 30 and someone who's age 50 is what I have put there. As you see, I do think that a good part should be in equities, which Indians today have probably in real estate. For most Indian families, real estate is 50-60%, which to my mind is not the correct approach. So good allocation to equities, some diversification through gold, and some investment in fixed income and real estate is what I think is a optimal way to save. So with that, I'll stop.
Thank you. Thank you so much, Mr. Manish Nirmani. I think due to paucity of time, you can keep the questions, and if time permits, we'll take it later on. So, okay, if you have any burning questions, one or two we can take, please. Actually, Mr. Manish has to leave shortly. So if you have any questions, so one or two we can take, I think. Yeah. Can you please directly go to the question, please?
Yeah, so if you are looking at time frames of 5-10 years, I don't think we should be worried about equities, because while valuation is high, it is general feeling among all that both on an absolute and relative basis, India's macroeconomic situation has never been this strong. So if you see India, typically inflation used to be 7-8%, today it's 3-4%. If you see our current account used to be 2-3% of GDP, now it is almost 0-1%. So in absolute terms, I know some of these terms might be technical, but basically the big numbers we look at from a macroeconomic viewpoint, they're very, very strong. And it is a fact that life is relative. So the amount of capital India will get also depends on how other countries are looking. And on a relative basis also, and I'm sure you'll agree that when we see China, when we see Brazil, when we see Russia, these are the emerging market which most global asset allocators look at before deciding to invest in India or not. Even on a relative basis, I think India has probably never been this strong. Maybe more because other countries have gone through big issues and it is still going through those big issues. Those big issues are not likely to be sorted in the next 5-10 years. So, both on the absolute and relative basis, I think that India's position is quite strong, and therefore, see, a lot of the big returns have been in the small and mid caps, the smaller companies and medium-sized companies. If you see the Nifty 100 or BSE 100, which is the large companies, on a 10-year basis, the return has been about 13% per annum, which is roughly in line with India's nominal GDP. One good benchmark you should use is if long-term returns are way above nominal GDP, then we should be very worried. So yes, the small and medium-sized companies can correct a bit because last 5-10 years the return has been very, very strong. But most of the market is actually large companies, and there the returns have not been that great. So we should be a bit careful, but I don't think we should be very worried at this point. So let's say, as per whatever plan you have, if 40% is equity allocation, maybe it's good to be 30-35. But I don't think we need to panic and make it zero or something.
Thank you. I think that answers your question. Last one. Can I speak up?
So, the metrics that you showed for different asset classes, gold versus many other indexes. So, that's clearly gold would be inversely proportional to the.
Yeah, equities.
But then, if you invest in both the classes, so one counterbalances the other.
So that's what we have to do some research, and maybe I'll just go back.
And there's a follow-up question on that. Maybe you can
Yeah.
answer that in the answer itself.
Yeah.
In gold itself, so then what is the best? ETF or the sovereign gold bond? And then the follow-up is, if, like he said, if you are already invested in the market, you answered very correctly, it's no need to panic, it's okay. But if I have to put in fresh capital, so then what is the best asset class in the next 1 month or 2 months time frame?
So one is just starting with the first question. There needs to be some research in what proportion you will mix equities, gold, international equity. So let's say we have a fund called the multi-asset allocation fund where if you see the data, it gives up some return because obviously 100% equity fund will give you higher long-term return. But the benefit you get in terms of reducing volatility or the up and down movement, more than we think compensates for the long-term return we are giving. So you need to crunch some data, but broadly, as they say, 80% gold, 20% equities, or 80% equities, 20% gold is a good combination to have. The second question was, what was it? I think ETFs are better because these sovereign gold bonds, sporadically they issue. When they reduce the custom duty, then you lose it. So it's very illiquid. Gold ETFs, you can buy 100, sell 10 rupees, come out whenever you want, you get the money back in 1 or 2 days. I think it's a very, very convenient product to own. And see, I can't predict short-term returns. As I said, we need to be a bit cautious in small and mid-cap equities. But long-term, I still think that if you have a 10-15 year time frame, then you should just follow the asset allocation plan. There's no reason to be panicky about equities and not put enough into equities as per the plan.
Thank you. Thank you. Please, can you can you go to the next speaker, please? Because we are really running out of time.
Thank you.
Thank you so much. I know that there will be a lot of questions. Please, you can have interaction later on. Thank you so much. Even I also have a couple of questions. Maybe later on. So we'll invite our next speaker, Mr. Shapan Man. Kindly, please.
Good afternoon, everyone. Thanks for giving me this opportunity. The lunch is waiting for us, so this session is always tricky, but I'll try and not make you sleep. Hopefully, you'll be wide awake by the time I finish. Bit about us. We are Man Ventures. We are one of the largest food manufacturers in the country. We have 14 units in North, South, and East of India. We do a whole host of products for a lot of these companies: Lever, Mondelez, General Mills, Orion, Cargill, OFI, Britannia, Nutricia, ITC, Unibic. And we've had extensive experience in working with a lot of these large FMCG companies. Just a snapshot of where our manufacturing units are located. Again, in North, we have a large number of capacities that have been created in Himachal, in UP, in Haryana, in Rajasthan. In East, we are in Bihar, Patna. In South, we are located in Bangalore. So we have a good geographical footprint, which we are able to service our customers with. A bit about the founder, Mr. S.S. Mahan, who's an alumnus of this prestigious institution, born in 98 in a farming family near Karnal. 58, he finished his secondary school from Karnal. That was his first exposure to English language. 67 to 70, which he calls the golden years, he spent here at the institution. 70 to 87, sometimes he jokes as a vanvas at Nestle, but I think he enjoyed his time there. 1987, he was a first generation entrepreneur and he started on his own. We're talking about 22 and 20, and beyond. This is where we are. We remain one of the largest manufacturers of a lot of food products that are sold in India. Now coming back to the topic, what is strategic financial management? So that generally has two aspects to it. It is basically how do you deal with the long-term capital allocation, and also whatever strategy, whether it is business or otherwise, what are the financial implications of that strategy are. So you generally think about these things. In any business, there are three aspects. One is production, the other one's marketing or sales. And the third prong is, it's the most boring one, but it is the necessary one, which is of finance. That how do we deal with it? So in the previous session, it was more about how do you generate and look after personal wealth. This is more about how do you look after the capital that you have invested in the business. So there are certain key aspects in strategic financial management. And these are the key things you generally look after: investment decisions, financing decisions, liquidity decisions, dividend decisions, if you have made it. And there are other aspects of financial evaluation, restructuring, corporate restructuring. But I think the first 4 bullet points are what we are going to delve into in detail. Investment decisions. Now, this is how you decide when you're starting a business or you're starting on your own, where you want to invest your capital and how do you want to invest this. Again, when you have capital and when you're running a business, there is again decisions to be made about what are your short-term goals and what are your long-term goals. Short-term generally is very, very, very important. Long-term, you need to do even deeper analysis when you're starting a business where, okay, what is going to be my net return? What is my internal rate of return? So these are very dry words, but they do help you in evaluating your business plan. But I think the overarching message from this slide is that cash is king. You should not run out of cash. If you have cash in the business, you will sustain yourself. If you do run out of it, then Bhagwan hi Malik hai. Financing decisions. So now the next aspect is that what should be the composition of your assets? How much debt you need to raise, how much equity you need to put in. So all these are very, very important decisions that depends on at where in the life cycle of a company you are. At the start of your company, you may look at lower leverage because your risk appetite is lower. But as you move along, your risk appetite or leverage may go higher. But again, it all depends, and coming back to the fact that whether you have done an IRR on your project or not. And depending on that, you should decide on what sort of leverage, what sort of debt you want to require to run your business properly. Higher of each one of those can be a suboptimal solution. If you have, typically the cost of capital for equity is much higher. As my previous speaker suggested, that you need to be making a return about 14% on the equity that you're putting in, while the cost of debt tends to be much lower, about 8.5%, 9% in current market. So those sort of decisions are quite critical. Liquidity decision. Now, I keep coming back to the point of why cash is important in any business. And you should do everything possible to conserve, that is cash, which remains in the business. And some of the strategies that I have mentioned here would help you in doing that. You need to establish, a lot of companies, what they do is they establish cash reserves. They establish treasuries. You have credit lines, you have credit lines from the banks, you need to use them very, very wisely. Strategies to accelerate receivables. People do bill discounting at all points just to accelerate the receivables. Leveraging payment terms, that's where your negotiation skills come in. One of the key aspects is, getting the MIS out in time. I see a lot of businesses where, the month has passed and the MIS and the finances are just not ready. In today's day and age, where there's a high level of automation, you have accounting systems, do invest in them. Get your MIS ready as soon as possible the month is finished, so that you know where you are. The last point is a bit in advanced stage. That's where you need to look at what your funding sources are. Is it the bank of mommy and daddy? Or is it loans? Is it venture capital or any other asset? So those are the things that you generally look after when you look at liquidity decisions. Dividend decisions. Now, if you have come to this point in your life cycle, in your life, then you have really made it, because you only give out dividend when you have made a lot of profit. So dividend distribution generally happens in case of profitability. So again, it's a very important decision, but as a budding entrepreneur, this decision is a few years out. Thank you so much for your time.
Thank you. Thank you so much, Mr. Khan. And I think we'll take up questions after the last presentation. Will it be fine? That is? Okay. So now I will invite our speaker, Bhima Vatra, and she will be speaking on asset management. And Ms. Bhima Vatra, please.
Can you do a presentation? And how do I do this? Okay. Good afternoon. I think we have only 10-15 minutes between me and lunch, so I wouldn't take very long. It's really an honor to be a part of this session on strategic financial management. We have introduced this session for the first time, and I hope you have takeaways from this session. So I thank the director, NGA President, Mr. S.S. Mann, to giving us this opportunity. So I will basically take you through building blocks for a strong credit profile dairy company. The framework that is applied is typical to a manufacturing company. So even if you work for a food company, the parameters should be pretty much relevant here. So my presentation, once you're done with the credit risk assessment, it's typically communicated. So I will introduce you to the language, the symbols that are used to define credit profile of a company. The third section is a case study and key financials of some listed dairy companies. You would have heard about these companies mostly on technical and processing side of parameters, but I want to enrich your vocabulary with some financial terms. Some of the terms that Swapan has already introduced, I will also try to cover some of these terms, and I hope you understand some of those terms when you listen on TV or read the newspapers. And the final part is a secret one. I really enjoyed researching and putting information together on these companies. I'm sure you'll feel proud and inspired if you're young going through the last section. So we'll start with the first section. See, the key parameters for evaluating any company starts with industry risk. And these risks are common to all companies. Financial risk mostly is quantitative. Rest of the parameters are qualitative. And there are strong interlinkages. For example, if you were to look at Nestle, it has very strong business risk profile, and therefore it enjoys very good market standing. And when I say market standing, it doesn't mean that DT students prefer to join Nestle, that's their first choice. It borrows at very, very competitive rates. And also when it goes to equity markets to choose Nestle. So, I have moved all that to annexures. I'm hoping that some of the students and faculty members and of some of my seniors and juniors go through the annexures and have some interest. It started with close to 10%, the margins dipped to close to 0, and then these improved. So how does one communicate that Nestle is better? Do you say the operating margins are higher, or operating margins have been very steady, or all DT students prefer to join Nestle, therefore Nestle is a better scale? AAA is the highest credit rated company, which is the safest. So when you when you hear about SBI or ICICI or Nestle, these are all highest rated companies. So just rating is not enough, but where you're placed on the scale, pretty much like your CGPA, determines how safe or unsafe you are. So let's figure out that what could be the credit rating for a Parag versus Nestle. I have a case study. So again, but there are several negatives. Now, all the players operating in an industry would face these challenges. These challenges are around procurement prices, events, diseases, and anything that could impact the sustainability of operating margins. So let's see how this company is doing. It's a South-based company. It's an established brand. It's a B2C company. It has a large consumer base and also a strong connection with farmer community. So the outlook on growth of the company is closer to 10 to 15%. At the same time, value-added products for the... Let's see how this business risk profile translates into profitability. So despite a moderate business risk profile, its profitability is robust. So return on capital employed, that's one of my favorite ratios for evaluating businesses, is over 20%. So the example that Manish gave, so if a bank FD is giving 7.5%, this company is generating closer to 20% for its owners. So pretty decent company on profitability. Now when a lender looks at all the building blocks, So daring, possibly industry risk, wouldn't go beyond A. On business risk, this company is pretty good, so A again. And if you were to put financial risk, which is at AAA, overall, this would be a AA category rating. So that kind of completes giving you 169 rupees. That's what is Nestle for its original shareholders. So higher ratings are typically driven by strong business risk and strong financials. So now we have covered the risk profiling and how ratings are communicated. That Sopan is managing. So this company is rated A-. I'm sure it will progress very well on the rating scale. So operating margins are 17 to 18%. This is old data. This is what was there in public domain till FY23. And if you see, the rating is driven by strong market position and a very strong financial risk profile. The second company I have covered is Red Cow. The name sounds familiar, right? Okay. So we don't have Mr. Majumdar attending. Would be happy to help. Thank you so much for your time. Would be happy to help. Thank you so much for your time.
Thank you so much. Thank you so much, Batra. And I hope that our daily companies you will assign. And I hope that our daily companies you will assign good rating, AAA like that, always.
Companies also, and as for the vision of Prime Minister, we shall asking for the national vision of Prime Minister, we shall asking for the national finance planning excellence. That's why he want to ask us to go and get more dollars from outside, so we can able to manage also. So being a person expert in finance and also take a risk management, years of work we work on social and people are getting very bad opinion about the milk assets. See what happened in this Sharma told very clearly when he made a plan of getting the laddu, Tirupati laddu. People are afraid to get any laddu also. When I want to come to here for a program, they told me by South में आते को कुछ भी लाओ कोई दिक्कत नहीं, मगर कभी तिरुपति laddu मत लाइएगा वहाँ. इसी तरह का इंटरेस्ट होने से क्या हो गया कभी तिरुपति laddu मत लाइएगा वहाँ. इसी तरह का इंटरेस्ट होने से क्या हो गया the market become very much restricted or if not you can able to share that also. Thank you very much.
So I think financial planning for a country is a big subject, but one or two pointers. You need to create a marketable and saleable product. That how you are looking after your livestock, what is the quality of the raw material you are getting, what is the quality of the packing material you are getting, and that is how you become export ready. Yeah. The other thing is, see, food tends to be a perishable commodity. So a lot of work needs to be done that how do you improve the shelf life of the products that we want to sell out. Quality of the raw material is key. So whether it is on pesticide level or on the other things, how we can work so that you get the right raw material. Thank you so much.
So I think
my question is to Viva. It's a nice presentation. You have given grading based on profit from 6% to 23-24%. I think you have given.
Okay. First of all, I haven't given the grading. Actually, these are given by professional credit rating agencies. I just put the data together. And I've been a rating analyst, so it was easier for me to just combine the rating knowledge with the data. So, innovation is very important. When I talked about the business risks, so suppose you are a simple company, what you would do is you would collect milk and process it and sell it. So So the operating margins that you get would be typically 7 to 8%. But if you innovate and if you have deep pockets to innovate, you can move to value added. If your return on capital employed is high, even if you have put in significant investments, you can repay your debt and your coverage ratios will improve. And that would push up the ratings. And that's what typically happens. The companies which invest in innovation, it can be product innovation, it could be packaging innovation, it could be supply chain innovation. Typically, so it is very companies, typically there is a benchmark and when equity analysts look at it, they say that what kind of revenue is going into R&D. But I don't think dairy industry is so evolved that we can do that percent.
With this, we are at the end of this session. In summary, I just, in one sentence, I just want to add in the summary that that we must have the habit of wealth creation. Second one is your cash is most important, so you must have to have the flow of cash in your business. And third is that always keep the credit worthiness high so that your rating will be good. And because somebody is watching you, when you are going for a loan, that you don't know that what is the rating score of you, but CIBIL score that says everything that even you don't know that why am I. So with this, I would like to thank profusely all the three speakers, 11 speakers. Thank you so much for inviting us. And I would like to thank my rapporteur also for noting down all the key points. And all this audience, all the students, those who have actively participated in this session, and I know that there will be many questions with you, and always we can have the greater interaction during the lunch time, just now we are having. So with this, thank you.
Throughout with various key insights shared by all the speakers. We would like to hereby extend a hearty gratitude to the chairman, rapporteur, and the phenomenal speakers of the session.
Now I request Mr. S.S. Man, President of NGA, Director of ICR NDR, Dr. Dhir Singh sir, to come up on the stage and felicitate the speakers, chairman, and rapporteur of the session. ग्रुप फोटोग्राफी वाला तो बोल देना नहीं बोलना ना आई रिक्वेस्ट यू कम टुगेदर फॉर
On the delegates.
सबको देने के बाद एक बार बोल देना
Thank you, sir. With this, we have completed our technical session 5. I have an important announcement to make that our special session that is on Institute Industry Meet will be starting at 2:15 p.m. So I request all the heads of division and industry personals, because it's going to be a panel discussion, one-to-one questions, Industry can put up their questions, and what as a research institute we are doing, our faculty and heads of divisions will be here, so we'll be answering your all queries. So I request that all the industry personnel and the heads of division along with their faculty please reach in the auditorium so that we can start this special session on time. Thank you so much. Now we'll break for the lunch. Thank you.